Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I'm really excited today and a bit nervous because I've got Louis Christopher from SQM Research, who's always a straight talker in the podcasting world. Louis, welcome. It's fantastic to have you on.
Oh, g'day, Peter. There's nothing to be nervous about. I can assure you of that. All good, mate.
Yeah, also from a technical standpoint, because just for a change, it's absolutely bucketing down with rain here in Queensland. So hopefully the infrastructure holds up. So let's get into it. Louis, tell us a little bit about your background, where you're from and where you grew up and so on.
It's a bit of a long story, maybe a bit of a dark story on the outset in being absolutely upfront. But it gets to the point of explaining why I'm doing what I'm doing. I came into this world, I guess, a bit behind the eight ball. I was actually an orphan when I started out. I never knew my father at all, and unfortunately, my mother passed away when I was 5 years old. My grandparents raised me. My grandfather loved financial markets. He was an accountant by trade, and he would regularly take me down to the stock market, the Sydney Stock Exchange, when it was an open cry system when I was younger, and he had an investment property or two. And he always had a love-hate with investment property, I can tell you that. This was back in the late 70s, early 80s, and he loved to sort of look after his own properties as opposed to outsourcing it to a property manager. But I'd always see his dismay when a tenant would leave and the state of the house would be when tenants would leave. Generally speaking, back then, the tenants just didn't give a damn. I would always see his major disappointment in terms of having to fix a property up after a tenant would leave. So I had this kind of love-hate relationship, I guess, or he had it. And I did see a bit of a dark side to property when I was younger, but I also saw a good side. I guess what really moved me towards the property information scene was actually after my grandfather passed away and there was an investment property that went to my grandmother. Unfortunately, she was ripped off in the sale of that investment property. She wanted to sell up and just have some cash to live on. I won't go into the details, but she was significantly ripped off on the sale of that property, and it was predominantly because she hadn't had any information. And the property manager looking after that property just took advantage of her lack of information and understanding in terms of the market. And I saw that firsthand, and that really had a major impact upon me.
Yeah, I've always noticed that you are very consumer focused, or you're on the side of the consumer, and you've got a sort of hatred of spruikers and rip-off merchants, of which there are many in real estate or have been over the decades.
It's fair to say, Peter, some people mistake that I hate property. I don't. I definitely regard real estate as part of that should be part of everyone's portfolio. But people do need to be careful in terms of how they go into the market. They need to ensure that they're paying fair value. There's still, even in this day and age, it's still easy to overpay for a property. And it's still easy in this day and age to undersell a property. Mind you, of course, many vendors, when it comes to sale time, they have an overestimated view of their property quite often, and it makes an agent's life very tough. Yeah, I've never been against property per se. I am, of course, against those who blatantly set up certain seminars where they're selling products beyond property. Yeah, I'm very cautious about that. I do think property should be a little bit more regulated than what it is. Not that over-regulation helps. So if I look at the financial services sector for financial advisors, I would argue perhaps that sector is being a bit overregulated now. But nevertheless, I'm definitely for property, and I love markets overall, and I love providing the best information possible on markets. So, I've always had a passion to try and improve information out there so both buyers and sellers, and indeed the industry, can make better decisions in the marketplace.
Yes, I think the regulation thing it can be a finely balanced act, can't it? Because I think, as you said, in financial advice, it's gone too far the other way to the extent that people are leaving the industry in spades, and that's not really helping everyday mum and dads to get the financial advice that they need. But of course, you need rules and regulations in place. And I think in real estate, sometimes there's not enough, particularly in terms of things like hidden commissions and licensing and so on. This is a slightly personal question. You don't have to answer it. How your background obviously sounds like it was pretty tough growing up. How do you think that's influenced your journey? Because you've always been known to me as a very straight talker, and you don't seem to suffer fools gladly sometimes. Is that partly of putting it nicely? But is that partly an outcome from a tough upbringing?
Look, maybe. Let's remember, though, you're probably taking a few comments off Twitter, and I'm pretty active on Twitter, and I'm sure you will agree Twitter's a bit of a wild place, right?
The double-edged sword.
It is. And look, I don't mind that. I don't mind it at times. Sometimes it can get really nasty, as you've experienced yourself. I'm interested in improving understanding. And look, I think for the average person, it's hard to get to a deep understanding on the housing market or other investment markets. That person, of course, is focused on their work and on their family, what they do, what their trade is. So I've always got plenty of time for people who are seeking information, trying to understand more. That's what I want to do. Though there are people out there, of course, who no matter what you bring to the table, they want to discredit you just for fun, And yeah, sure, I'll come down on them if I think that's what their angle is. But I think as I'm getting older, I'm caring less about those people anyway. I think the whole thing with social media is that it is ultimately very disruptive and creates a lot of division out there. And I think a lot more and more people are realising that now. And just some of the dark sides of social media, that it has created greater division in society. But, that's a philosophical point of view, and we probably don't want to go too much into that today.
No, something to be wary of, especially as I'm bringing kids into the world now. So The big thing I wanted to ask you about today was inflation, because I think this is an absolutely critical thing that's on the horizon. In fact, it's happening right now. Before we come on to that, just tell us a little bit about SQM research and what you do, and then we'll come on and talk about the big story, which is inflation.
Yes. Well, as you know, mums and dads know us predominantly for our housing data and our housing market data and our rental vacancy rates, and now more recently our auction clearance rates and our stock and market data. We do a lot more than that at SQN Research, funnily enough. There's a wider and deeper division which does analysis and research on managed funds in this country, where we actually issue ratings. And it's hard for me to sort of put all that stuff out there in the public, because that's really only for financial professionals. We operate that part of the business under a license that we have with the Australian Securities and Investment Commission. But we actually do, as part of the business then, we actually cover all asset classes. So when it comes back to the property data and our thoughts on the property market, I think we're actually in a pretty good position to do it from a very objective point of view, where we don't care if the market's going up. We don't care if the market's going down professionally. It has no bearing on our business model whatsoever. We don't sell real estate. And since we do cover all those asset classes, all the other asset classes, we are able to, we think anyway, bring a more objective point of view. So, yeah, that's the nature of the business. It's been growing and it seems to have a good reputation in the marketplace. We have 17 people on board now. I launched the business in 2006 after I left Australian Property Monitors. Some of your audience may recall I was general manager and head of research for that business for 6 years. Before that, I was back over in the financial markets where I was an editor with a group called the Securities Institute of Australia. And then before that, I was in a grunt job back in the 1990s working for MLC straight out of uni. Yeah, that's the history, but I've always had a personal passion for information and trying to improve that. And I'll keep going in this business up until that point and until that passion goes, I guess. But it's still there. And I still very much enjoy covering the housing markets as best we can.
Yeah, we'll put a link in the show notes because there's loads of information that you put out there for free in terms of things like vacancy rates and asking prices and rents, and there's no end of information there. City level, suburb level, is really useful stuff for the everyday consumer just to get access to information that they might not otherwise have. So, as you can maybe able to hear in the background, I've been reading this silly phrase in the media about a rain bomb, but actually looking out the window, it's probably not far off what is actually happening. It's a bit of a storm rolling in here. We might talk a little bit about the floods in Queensland and New South Wales shortly. Let's talk about inflation. This is really interesting subject, and I wanted to get your take on it, Louis, because you're a thought leader in the real estate space. I guess after the global financial crisis, when we started seeing quantitative easing and money printing, and then we never ever really thought there was going to be a lot of inflation, and because it never happened, I think we've got into a bit of a complacency about the low inflation environment. Now we've got the issue with sanctions on Russia, which is following on from a couple of years of COVID restrictions. It's creating an enormous supply squeeze, and we're seeing inflation. Well, there was the gas price spiked by 70%. Oil prices are over $110 a barrel. So that's going to impact us in terms of petrol prices, energy bills. I think you would know better than almost anybody that rents are probably going to spike this year. So look,
on our numbers, as a capital city average, they're up by over 8% for the last 12 months. And then when you look at the more recent numbers over the last 90 days, basically just over the last 90 days, they're well and truly up by over 3% to 4%, depending on the capital city. So rents are accelerating in this country.
Yes, and I guess with the flooding in there's 15,000 homes impacted in Brisbane, but I mean that was a few days ago, and now New South Wales is being impacted. Borders are open, but I guess that all this adds up to inflation probably accelerating. We're at 3.5% on the headline figure, but it's not just those items. We've got the price of a lot of commodities going up as well. So It's becoming a bit more broad-based now. And I went to Woolies in Noosa the other day. There's just literally nothing on the shelves. You know, there's a bit of panic buying, but Brisbane floods have created a new problem in terms of supply. So look, you throw all of this together, not out of the question that we could see very high inflation. So, Louis, what do you think that could mean for monetary policy, the housing market? Because I guess with an inflation target of 2 to 3%, which we may well now overshoot significantly, what do you think the Reserve Bank might do? Will they lift rates to stop higher inflation, or will they be a bit timid on that front?
Peter, I think the Reserve Bank of Australia has been pretty clear in terms of what they want to do. They want to see through this inflation. They, in my opinion, still believe it's transitory. And so they're looking through to the other side, thinking that this acceleration in prices of many goods and services will come to an end. But I'm not so sure anymore. They're also at the same time saying we need to support the economy, particularly in light of recent events with Russia. So based on their last communication, I don't think rates are going up anytime soon. Yet we know inflation is accelerating. We've got a headline rate of 3.5%. I think the probabilities are now very high. We'll see at the end of this year a number towards 6%. And there's a possibility we'll even see 10%. And that may sound outrageous and like I'm gaslighting, I'm creating alarm. But the truth is that the European Union is now currently running with a headline inflation rate of 6%. The US is running with a headline inflation rate of over 7%. It's happening. It's happening worldwide as we speak. So I don't think I'm being alarmist or unreasonable to think that we're going to see at least a 6% headline rate at the end of this year. Now, if I'm right about that, the RBA will have to act. They will have to lift rates. But I see a scenario here where they do a rate hike, and it's effectively what I call a virtue signal rate hike, right? So where they say, all right, well, okay, let's lift interest rates by 50 basis points. But the problem is that if we're running at an inflation rate of 6%, we've got a situation where they're not covering for that inflation rate at all. And it still leaves a door open for even greater inflation or even higher inflation. Now, what's the relevance of this to the housing market? When you see times of higher inflation, people want a hedge against that. And they generally look to real assets, tangible assets to get that hedge. In the 1970s, Sydney house prices actually quadrupled over that decade. They lifted by 4 times. Why did that happen? It happened because of inflation. At one point in time in the 1970s, Australia's inflation rate hit 17.5% per annum, a huge number. And that was because of the energy crisis that was created at the time from the Middle East. We're getting a similar energy crisis now on multiple fronts in terms of food as well as energy. Now, maybe it's not an absolute embargo. Of course, what happened back in the 1970s was OPEC literally cut supply dramatically to lift prices. We are seeing a sort of potential cut in supply if we assume that we're not going to get access to the resources out of the Ukraine and Russia. And that's the reason why the markets are reacting the way they are. But let's recall, even before this current crisis, inflation was already accelerating. We're already seeing a rise in these base commodities, these soft commodities. So going back to real estate, people look for a hedge. And as a property investor, doesn't it sound fantastic that you could buy an investment property on a yield of, say, at the moment, about 4%? You could still borrow the money at 2.75 to 3%. And then in 12 months' time, the odds are pretty high you'll be able to lift the rent by 8% and even more. So I think investors are likely to respond to a higher inflationary market and jump into the market, just like they did back in the 1970s.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
Some of the numbers coming out of Europe, things like producer price indexes, because of the supply shock, I mean, we say numbers like 25% in Germany and elsewhere. I guess what they always used to say was that higher inflation could lift the expectation of higher inflation. And once that genie gets out of the inflationary bottle, you could go into this sort of inflationary spiral. But it's almost like going back to the textbooks, because we haven't had to actually deal with anything like this, as you said, for 3 decades now. But I guess traditionally it was said, yes, you look towards hard assets like tangible items of value like gold or precious metals, real estate. But I suppose the caveat is probably if we are at risk of seeing higher inflation, you probably want to be a bit careful about the price you pay, but particularly overloading on debt, because you could see a higher mortgage rate over the next, say, 1 to 5 years. Does that kind of make sense in your worldview?
It does. I think at the end game of this, in terms of this cycle, the end of this cycle will be that the central banks will be forced to aggressively lift interest rates to get on top of inflation. Society will demand it of them to do so. I do think, too, there will need to be a bit of a changing of the guard where new central bankers will need to come in, more hawkish central bankers who are willing to take the hard decisions to do this. I'm not so sure the present leadership, which have generally been dovish in nature, are willing to suddenly really change their view of the world too much. They'll be too cautious of creating a recession. They generally have a mindset. Not every central banker out there, but a number of central bankers out there have a mindset that it's okay to kick the can down the road. So this goes back to my point that I think, yes, we may well see a rate rise out of the Reserve Bank of Australia, but it will not be enough to create what I call positive real rates, where the real interest rate is in the positive. At the moment, real interest rates, after taking into account inflation, are actually in the negative, which generally creates increased money supply and juices up asset prices. So there could be a bit of time, but you're spot on that in this environment, yes, get yourself some tangible real assets, but be careful about taking out debt. Yes, for now, debt will devalue, but there will come a point in time where we'll see interest rates more than covering the inflation rate. And they will be hard times where you do not wish to be overly exposed to debt.
Yes, and the regulator is now requiring that people can repay mortgages with a 3% buffer, which, if what you're talking about comes to pass, would probably be a sensible piece of regulation. Just looking out the window, this bucketing rain. Let's talk about another thing. We already touched on the extremely tight rental markets. On your figures, I think the lowest or tightest vacancy rates in 16 years. Now we've got borders opening. So from 21st of February, vaccinated visa holders could finally come into Australia. We've got, I guess, a 2-year backlog of people wanting to come. And now we've got this terrible flooding in southeast Queensland, which seems to be heading towards the Hawkesbury, parts of Sydney. What do you think? I mean, my experience in Sunshine Coast, I've never seen a rental market like it. It's extraordinarily tight. Gold Coast the same, or certainly the main strip.
Yes.
So what do you think might be the impact of this? Because I guess 6 or 7 years ago, we had a big boom in building high-rise apartments. Doesn't seem to be happening now. So potentially much higher rents over the period ahead, do you think?
In the immediate period, there's nothing in our leading indicators to suggest the rental market's slowing down in our capital cities. You're right. Rental vacancy rates are at 16-year lows at 1.3%. That's at the national level. They are now, have been tightening in the last 6 months for Sydney and Melbourne, whereas you may recall on the outbreak of COVID, we actually had a bit of a spike in rental vacancy rates for those cities, and a period in 2020 when rents actually fell in our 2 largest capital cities. But that's all been changing. Rents are now accelerating in Sydney and Melbourne, but they're still galloping along in those areas that you speak of. We're talking rent rises over the past 12 months in southeast Queensland towards 30%. I've never seen that before. We're still seeing a very strong movement of people from the southern states into southeast Queensland. And with the borders open, the interstate borders open, that's making that trend easier. Yeah, it's easier now to move to Queensland. People want to move to Queensland. So I'm seeing nothing there at this point in time to suggest relief is at hand. Now, when it comes to the floods and we consider the Brisbane market, yes, there's no doubt there's been a number of homes affected, and that will affect the inner Brisbane housing market in particular in terms of the rental market. I'm getting the question of late in terms of what does it mean for the for sale market? Are we going to see suddenly mass discounting in the Brisbane housing market? I don't think we will. And I say that because many of these homes already were categorised as being flood zone homes, and they were already significantly discounted compared to a like-for-like home in an area outside a flood zone. So far, Brisbane's flood zones, designated flood zones, have held up true. So in the Brisbane metropolitan area, at least, there hasn't really been new flooding areas which weren't previously marked up. Of course, properties which have been damaged in this current environment, if one were to sell those properties right now, they will probably sell it at an even greater discount given the damage and given the fact we've had yet another event. I don't think the Brisbane market as a whole is going to be affected by this event. Now, northern New South Wales is a different matter altogether because there's been a number of areas in northern New South Wales which weren't necessarily marked as being flood prone, or it's been a very long time since they've been hit by a flood. And so there is an increased probability that we will see some discounting, renewed discounting occur in a number of regions in northern New South Wales, naturally the ones which have been mostly affected by this event.
Yes, yeah, this is why I wanted to get you on to the show to talk in this level of granularity, because probably more so than anybody, you have access to real-time figures to show what's actually happening on the ground. And yes, to your point on rents, particularly Sunshine Coast, I mean, I've seen those 30% rent hikes that you talk of, and as you said, there's really nothing for rent, so it's hard to see that trend changing anytime soon. One of the interesting things, it's been a bizarre couple of years. We've had effectively no immigration now for 2 years, and it's just starting again. And as you mentioned just before, the demographic trend in Australia is very often for people from Sydney and to some extent now Melbourne to relocate to southeast Queensland. But traditionally, the new migrants have gone to Sydney and Melbourne. Now, I guess that trend is just starting again as the borders reopen. Bearing in mind what you said about the potential for high inflation, where do you think might be the stronger performing markets over the next, say, 10 years? Do you think the capital cities will be resurgent as immigration kicks off and as COVID fades into the rearview mirror? Or do you think the regional renaissance will continue?
That's a really good question.
Well, people keep asking me, so I thought I'd flick the question onto somebody who knows more about these things.
Let's consider the immediate period, and then let's speculate on the 10-year period. So, I often get the question is like, hey, with the borders closed, why did we see rental vacancy rates fall so much as they did? I mean, it doesn't make a lot of sense, particularly for the fact we've known that in 2020 there was about 170,000 dwellings completed, and in 2021 about the same number again, right? And yet the absolute population only increased by roughly 30 to 35,000 people over that time. So there should have been a pretty big increase in supply, and we should have probably seen a rise in rental vacancy rates, but we had the reverse. Why? It's a difficult one to answer, but I think the answer somewhere lies in housing formation. So I think there's been a rapid increase in housing formation. People have been wanting larger homes, and they've been wanting to live with less people around them. And so if we take that view of the world, and that was as a result of COVID, of course, and more people working from home as opposed to being in the office, I think there's a possibility in the immediate future with COVID kind of behind us. Mind you, it certainly isn't in Western Australia. They still want to go on as though it's a massive emergency. With COVID largely behind us and with the borders opening, there may well be a bit of a reversal that housing formation, particularly with the pickup in rents. Potentially people will be willing to live with more people around them, and there will be potentially a move back into the cities. And in fact, we think we're seeing it in our numbers now. If you look at our rental vacancy rates for the CBD areas and the inner city areas of Sydney and Melbourne in particular, we're recording some big falls in rental vacancy rates in those high-density locations. So I think we'll see a bit of a reversal. Long-term, given the fact that it's likely affordability is still going to be an issue with us for some time yet, given the fact that I think that we may well have now a permanent shift in terms of working from home, that I think the regions, particularly coastal regions, are still going to be in demand over the longer term. They offer affordability, unless, of course, you go to some of the more recognised areas of, say, Byron Bay and others, where, of course, the houses there are not affordable, far from it. I think, yes, the coastal regions are likely to remain in demand. I think Brisbane is likely to be in strong demand right up through to the Olympics, and potentially some Australian regions as well. But I am more cautious of those inner regions, particularly if they've not been supported by a township that's going places. Yeah, I think that's probably where it's at for now. I think eventually we will see a supply surge come through, eventually. But it's not helping when you see, for example, stamp duty increases or the charges just recently introduced by the Victorian government. That doesn't help on the supply side.
Yes, I've been down in Sydney a little bit last few weeks, and January was extraordinarily quiet, but it does seem to be that the cities are getting busier again, mobility picking up. I think the rental vacancy question or conundrum is a very interesting one. I think anecdotally, a lot of younger people post-lockdowns, I think they just wanted to get out and get their own place and rent. But maybe also there's been a lot of money splashing around the last couple of years in terms of fiscal stimulus. And I think when people do have extra money to spend, they buy second homes. And maybe that hasn't done a lot for the rental stock, but people have bought regionally, maybe a bolt hole to get away from COVID. So my final question for today, what do you see for the rest of 2022? Obviously, it's an election year, maybe not such a big theme this time around compared to 2019. But what do you think with the potential for rising inflation and all the things that you mentioned? How do you think the housing market will fare this year?
Well, Peter, as you know, each year, roughly around November, we put out our forecast for the up and coming year, and through our what's known as our Christopher's Housing Boom and Bust report. And for 2022, we did say that there was going to be a slowdown, but it wasn't going to be a major downturn. And we believe that inflation would provide a bit of a tailwind. And, if you go off the core logic numbers, they are suggesting that there is a bit of a slowdown. So our forecast nationwide was generally that prices would rise somewhere between 0 to 5% overall. We thought Sydney and Melbourne could record potentially some minor price falls. But as mentioned, it would be dependent upon what inflation does, whether APRA jumps into the market or not to potentially slow down the market. I don't think they will now. I think they'll hold fire, given there is evidence of a bit of a slowdown in the capital cities, in the large capital cities, that is. And then, of course, what the Reserve Bank of Australia does with regarding interest rates. There is a scenario that plays out here, as mentioned before, and I think it's increased in probability, where you see APRA not do anything, at least until mid-year, because the market's slowing and they might not jump in at all. You see an acceleration in inflation. So we assumed a 5% headline rate by the end of the year. I think the probabilities have increased now that it's going to be greater than 5%. And the RBA still does nothing, or they do maybe a quarter or a 50 basis point rate hike sometime later 2022, but it's not enough to tame inflation. Now, under that scenario, what potentially we could see is really just a fleeting slowdown where, yes, the capital cities, our two largest capital cities, slow down a bit like they are now, but then they start to pick up again, driven by investors and other home buyers looking to get that hedge, as talked about before. Yes. I think they really could play out. And as for the other capital cities, I don't think we're really seeing much of a slowdown at all. Our forecast for Brisbane, for example, was that prices would rise somewhere between 8 to 14%. We're very confident on that view based on how the year's opened up. We're very confident about that view. And the other city that we were confident about was Adelaide as well. We thought double digits were quite possible in terms of another pickup. And I'm not seeing on our numbers any real slowdown in the Adelaide housing market. So those are the two capital cities where we're more bullish on. And I do think Brisbane, no matter what happens to Sydney and Melbourne, Brisbane's likely to beat those two cities. I'm very confident about that.
Yeah, Brisbane has had an interesting few years, and as you said, 2032 Olympics coming into view over the next decade, and I think a lot of people seeing the benefits of a Queensland capital city lifestyle. Obviously,
well, it's a standard of living change. The reality is Brisbane house prices are still cheaper than Melbourne and Sydney. Right now, as we speak, still considerably cheaper. So for an income earner that's sick of paying a huge mortgage or cannot get into the Sydney and Melbourne market, there's Brisbane. And there's good opportunities in the Brisbane economy right now, especially with the rise in commodity prices, which generally Brisbane has some positive correlation to, for lack of better words. So, yeah, I'm failing to see how Brisbane's going to have a bad year, Pete, unless we see a real aggressive rise in interest rates and or we see real aggressive action from APRA. And I just don't think, I think APRA in particular are more focused on what's going on in Sydney and Melbourne rather than the other capital cities.
Yeah, makes sense. And as you said, it seems that the rents in Adelaide have been on the up, and not much sign of a slowdown there. And I guess prices doing something similar. Louis, you mentioned your Christopher boom and bust report and also all the other SQM data that you put out there. Where should people go if they want to get access for more?
Oh, look, they just come to the website, sqmresearch.com.au. And there they'll find a lot of free information. And, if they're feeling trustworthy enough, there's plenty of paid reports there too.
Fantastic. Thank you so much, Louis, for coming on. It's been great to get your first-hand insights of what's happening right across the country. Look forward to hopefully catching up in Sydney sometime soon.
Sounds good, Pete. Would love to do it.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.